Welcome to the monthly chart, our bird's eye view of EUR/USD. For the past 5 years, price has been climbing this yellow trend line. Think of it as the market's up staircase. Every dip into the blue zone, around 1.05 to 1.07, has attracted heavy buying. That's our support floor where long-term investors say, cheap enough, let's load up. On the flip side, the red band near 1.14 to 1.15 is a stubborn resistance ceiling. Price keeps bumping its head and falling back. So long as candles keep closing above the trend line, bulls hold the steering wheel. A monthly close below that yellow line would tell us the staircase just broke, and a deeper drop could follow. Remember, monthly moves are slow but powerful, setting the tone for every smaller time frame. Zooming into the weekly view, we're still inside the monthly uptrend, but notice the mood shift. Price has dipped under the yellow 50-week moving average, like falling below the middle lane on a highway. It signals a medium-term pullback. Watch this blue demand zone around 1.07 to 1.08. It lines up with a prior base. If we print a nice green rejection candle here, it tells us buyers are defending the floor. Up top, the red strip at 1.1120 to 1.12 has capped rallies 3 times. Until we close above it, weekly momentum stays on the back foot. Swing traders can plan 2 plays, fade the dip at support for a ride back to resistance, or short any weak bounces for a stab toward 1.07. Structure will decide. Let price show its hand first. On the daily chart, the story tightens into a trading box. Price is ping-ponging between the same resistance roof near 1.1120 and support floor near 1.07. Notice the string of lower highs. Each rally tops out a little sooner. That's sellers quietly gaining ground. The best tactic here, sell the ceiling, buy the floor and avoid the messy middle. Confirmation comes from the candle itself. A tall red rejection wick at the top shouts, sellers in control. A strong green engulfing candle at the bottom screams, buyers back in. Manage risk tightly, stops just a few pips beyond the box edges, targets twice the distance inside. Simple range rules until we break out for real. Here's the 4-hour chart, perfect for data swing moves. Price is riding an ascending channel. The yellow diagonal below is dynamic support. Every test so far has seen bulls step in. A small blue demand pocket at 1.0830 to 1.0860 has triggered 3 rallies. Mark it. Overhead, a flat red line at 1.0990 is the current lid. If a candle closes above and then retests that line from the top, we've got to break out and go toward 1.1050 or higher. But if price slices below the yellow trend line and retests it from beneath, momentum flips and we'll likely revisit the blue pocket or even the daily support farther down. Let the candles vote, you just follow the score. Finally, the 1-hour chart, the fast lane. A downward sloping yellow moving average acts like gravity, pulling rallies back down. 1.0940 is our mini resistance shelf. Price keeps stalling there. Beneath, the blue support bar at 1.0850 to 1.0870 has caught falling knives more than once. Strategy: look for quick shorts each time a small red rejection candle appears near 1.0940. Target the blue bar and tuck the stop a few pips above the recent high. If bulls punch above the MA and hold, flip the script and aim for 1.0940 to 1.0960 as the first upside checkpoint. Remember, the 1-hour view changes fast. Stick to tight risk and exit rules. Now you know the floor, support, the ceiling, resistance, and how candles reveal who's winning the tug of war. In our next lesson, we'll see how these same levels look on different time frames. Don't miss it. Hit subscribe, ring the bell, and watch the video on bid, ask, and spreads that's appearing on screen right now. Trade smart, stay disciplined, and I'll see you in the next one.